It's almost 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian equities gain in a global rally fueled by bets that the Fed will soon start cutting rates. More investors are rushing into riskier parts of the market. Also ahead is a preview of Donald Trump's playbook for global trade, oil and China, and an exclusive interview with Bloomberg Business Week. Plus, big US banks crush estimates on equity trading revenue. We'll hear from Bank of America CEO Brian Moynihan. All right, let's get straight to our top story, though, as traders raise their bets on a second Trump presidency. Bloomberg Business Week spoke exclusively with the Republican candidate at Mar-a-Lago. For more, let's bring in Bloomberg News Desk editor Jill Desis. So, Jill, a lot to unpack from this conversation. Let's start with his views on tariffs and China. President Trump making familiar noises from what he was saying back in 2016 about tariffs, trade wars, and whether or not the US will come to the rescue of Taiwan. What are the takeaways here?
Yes, Paul, I think safe to say Trump is really just doubling down on a lot of those protectionist policies that we've come to expect from him. What we saw, particularly on the tariff front, were additional threats of even higher tariffs on China, in particular, new tariffs of upwards to 60%. He also, implied that there should be some kind of blanket tariff across all foreign goods of about 10%. So really doubling down again on that language about increasing those tariffs on trade, really becoming more protectionist. I think at this point it does seem like the Trump camp thinks that the fact that the Biden administration has actually kept a lot of the tariffs on Chinese goods in particular over the course of the Biden administration, that's really kind of validated a lot of what Trump was doing back in 2016 through 2020. So I think at this point, it's pretty safe to say that Trump came out in this interview being very firm on this idea that there could be, these increased tariffs here pretty much across the board. But obviously, as we've been discussing, very particularly on China.
Yeah, and let's talk about his remarks on Taiwan as well, suggesting maybe a major shift in US policy coming if he wins.
Yes, certainly. I mean, obviously, there's been, incredibly important diplomatic relations between the U.S. and Taiwan, particularly on the question of China, which, of course, China, says that Taiwan belongs to its own territory. What Trump actually said in this interview, he kind of came off as a bit, lukewarm on the idea of continuing to protect Taiwan, saying essentially that if there continue to be U.S. troops kind of, surrounding, protecting Taiwan, involved in a lot of these efforts, there are these military efforts in the South China Sea there, that Taiwan should ultimately compensate the U.S. in some way for that kind of protective action. He also had some comments there to, say about, the importance of bringing chip manufacturing and such back to the U.S. This, Paul, is kind of in line with actually what we've heard from Trump in the past on other allies of the United States, particularly NATO European countries. He's also said some stuff about, South Korea. The idea of, stationing U.S. troops, in Seoul and in South Korea is kind of a, protection against, aggression from North Korea, for example, saying again that the U.S. should, be compensated for those actions. So I think at this point it does seem like economic grievances, at the very least, seem to be driving some of those thoughts on Taiwan there.
Yeah, it was a very broad-ranging conversation as well. Also, he had some remarks on deregulation, U.S. domestic oil production. What's the plan there?
Yes, I think, also maybe no surprise here to see Trump talk about this idea of ramping up domestic oil production, sort of, removing some regulations to make that happen. At this point, I mean, safe to say the Trump platform that we really gleaned from this interview is maybe not, entirely outside the wheelhouse of what you'd expect. It's lower taxes. He also talked about lowering the corporate tax rate even further from that landmark 2017 Tax Cuts and Jobs Act under his administration. Now talking about somewhere in the neighborhood of 15% and increase, also, part of that is, increasing oil production, rolling out these additional tariffs. This is, all part of this, fairly comprehensive economic plan that Trump says he's putting together. Although I'd caution you, Paul, that we were still fairly light on details as to how exactly this is supposed to impact things that, Trump says that he cares about, like the budget deficit and such. We'll have to see what that would ultimately look like should he, get get a second term in office, if he does, upset Biden to win, which, as we've been discussing, based on a lot of the polling numbers and the recent action that we've seen just in the political landscape, does seem increasingly likely.
All right, News Desk editor Jill Desis there. And our next guest believes a Trump victory would likely result in a ramp-up in oil and gas drilling in the U.S. So let's bring in Mark Franklin, Senior Portfolio Manager, Asia Asset Allocation at Manulife Investment Management. Mark, in terms of oil and gas drilling, former President Trump talking about the U.S. being awash in what he calls liquid gold. What do you anticipate in terms of potential U.S. domestic oil production and the impact that it might have on oil markets?
If you look at US oil production, it's at all-time highs now, but it's really about sweating existing assets. One of the things that President Trump could do, should he win, is to reverse the ban on new exploration on government sites where there might be oil and gas deposits. So he would free that up, which would create greater new reserves to potentially exploit in the future. But we also have to bear in mind Saudi Arabia and OPEC Plus's role in global oil markets. If they perceive to be a greater push for increased US oil production, that may also impact their willingness to bring production and supply back onto global markets in order not to lose market share. And so actually a Trump presidency could preside over a material pullback in oil prices should some of that new exploration bear fruit in the US.
Yes, and there might be implications for the Middle East as well, because in terms of geopolitics, former President Trump making some remarks about pushing for peace in the Middle East, about what to do in the Ukraine, and then also those comments that Jill was just saying about perhaps a reluctance to come to the defense of Taiwan. I mean, can you even predict what a geopolitical landscape would look like under a second Trump presidency?
There's a big difference between geopolitical tensions and actual geopolitical flashpoints. If you look at the last two Democrat administrations, so Biden and Obama, we had the invasion by Russia of Georgia, the annexation of Crimea in 2014, the Syrian civil war, which precipitated a big involvement of Russia, and then the invasion of Ukraine in 2022. Under the first Trump presidency, tensions were very much dramatically on the increase, but the spillover into live and hot conflicts was much more muted. And Trump's approach really is to approach geopolitical conversations and disagreements via trying to exact leverage in negotiations. So he's a deal maker by nature. And so the whole idea about threatening tariffs, threatening to pull back military spending commitments is designed to apply pressure on either partners or adversaries to up their game or to think twice. So we have to sort of see a lot of what he says in the context of him trying to apply leverage, not necessarily giving us full visibility on what his actual policy actions would be.
Well, let's take a look at how some assets have been moving in the past few days, and in particular gold. I mean, we've seen gold continuing to push higher, extend its rally, so that looks like a haven trade. But at the same time, we've got the S&P closing at a record high for the 38th time this year. So are we risk on or not?
Yeah, the move in gold in most recent days and weeks is not a haven trade, it's a reflation trade. If you look at some of the indications from Trump and J.D. Vance, his running mates, in terms of their policy approach, it's to try and get taxes down, try and get rates down, boost onshore oil and gas production. That is likely to lead to reflation, growing global liquidity, which is positive for US dollar denominated assets such as gold. And at the same time, we've seen oil prices come off as well, which goes back to the point around stimulating production. So that's the context of what we're seeing. And then within equity markets as well, quite a powerful rally in small caps and other cyclical markets in US equities in recent days, and a rotation away from large cap growth. But it's not as if large cap growth has pulled back. So it's almost a case of expectation, should Trump win, of growing global liquidity, global growth, rising tide lifts all boats, but with a clear preference for kind of curve steepening proxies.
Yeah, and perhaps that rally that we've seen in equities might be better explained by some of the rhetoric we've heard out of Jay Powell and the Fed recently. What's your base case for easing at the moment? Is July live for you?
It's a very good question. If you look at current market pricing, it looks like September is rubber stamped as the first rate cut. probabilities of a rate cut in July are very, very low. But the question would be, if they signal at the later meeting this month, the July meeting, that they're likely to cut rates in September, you've basically got a 2-month window where markets could loosen up, financial conditions could ease, and so the actual benefits of the rate cut already get priced in. So there's what they will do and what they should do. What they will do is likely to signal in the July meeting that they'll cut in September, but they might want to well consider cutting in July, because 2 months is a long time in terms of data formation. And right now we've had 3 months in a row of undershooting inflation and the labour market showing signs of loosening. So why not capitalise on that recent data development and actually cut in July? But we think, all other things being equal, September is the most likely candidate.
All right, Mark Franklin of Manulife Investment Management is going to be sticking with us. Meantime, terminal users can read more from Bloomberg Business Week's exclusive interview with Donald Trump on the terminal and also on Bloomberg.com. Still to come on Bloomberg Markets Asia, we speak with the CEO of one of the leading asset and wealth management firms in India, ASK Private Wealth, and we discuss which sectors are getting interest from the wealthy in India. That's coming up later on this hour. This is Bloomberg. All right, let's check in on how markets are faring with Avril Hong in Singapore. Avril, what are you watching?
Yeah, a couple of things we're keeping an eye on, right, Paul, as Asia's stock gauge seems to be a bit firmer today and perhaps managing to snap those 3 straight sessions of declines. We're also seeing a bit of a reversal of the risk-off and the so-called Trump trade towards Asian equities. But I think what's in the driver's seat is really that Fed rate cut optimism that you were just discussing with Mark a short while ago, along with these hopes of a soft landing in the U.S. Don't forget, we got those bank earnings and pretty solid retail sales out of U.S. data overnight. So one of the things that we've been seeing in equities is that rotation and the outperformance in these smaller cap stocks versus the big cap names. Today in the Asia Pacific, we're seeing the cyclicals doing well. ASX 200 is outperforming, and that big boost is coming through from the Australian banks. We're also keeping an eye on the likes of TSMC, especially in light of what Trump said about Taiwan, Paul.
All right, Avril staying with us as we bring back Mark Franklin, Senior Portfolio Manager at Manulife Investment. Mark, I just want to talk about some of your calls here in Asia. You've got India, Korea, top of your list for conviction calls. Why?
Well, India still has a very strong secular growth story, even though the election was somewhat of a surprise in terms of the strength of the mandate that Prime Minister Modi won. It definitely refocuses the minds around the economic agenda, infrastructure build-up, but making sure that it enfranchises the rural masses as well as the urban populations. That's generally bullish for corporate earnings in the Indian equity market, but we do recognise that valuations have rebounded significantly since that initial pullback. And as for Korea, there's a couple of angles that we like there. One is the strong upside in semiconductor and memory returns and prices, which benefit the largest index weights there. It also has some exposure to battery technology and alternative energy innovation. And then the second angle really is corporate governance reform. So the announcement of the Value Up program a few months ago kind of fell by the wayside a little bit in terms of the recent parliamentary elections. But clearly, Korea has looked to the success of Japan in initiating corporate governance reforms from a bottom-up perspective. And the Korean market has experienced for some time that corporate governance overhang in terms of valuation discounts. So if they're able to make inroads there, that will definitely attract foreign capital and investor allocations over the years ahead.
Mark, what about some of the more export-reliant economies like Singapore? Today, we get that exports data. It was a big concern, given how it was also much slower and there was a downward revision to the prior month. And electronics weakness was part of this. So when you look at chip stocks out of South Korea, do you think this is part of, a bit of flashing of a warning sign, especially as potential US-China tensions heat up?
I think there are two things going on in terms of disruption to trade flows. One is the cyclical side of things. and it's a reflection of the relatively muted economic conditions in China. China being a big sort of end market for consumer electronics. That's the cyclical side. It remains subdued, and there aren't really many signs that it's going to pick up meaningfully anytime soon. Then the second driver is more secular in nature. It's basically the upending of the global trade relationships that we've experienced in the last 30 years. If you look at trade momentum as in the US with other trading partners, there's been a big shift away from China, more towards the friendshoring candidates or alternative sources of supply in order to diversify away from China, given the disruptions that we saw during COVID. That is affecting Asia regional trade flows, and in particular, the demand for tech exports going into China.
It's important that you made that distinction, and for China specifically, when we look at these new productive forces that Xi wants to see as helping to kind of fill the vacuum from real estate, do you think that 60% tariffs will sufficiently target this export growth engine?
I think ultimately China has to look at the consumer being the driver of economic growth with a future economic model. Obviously, infrastructure and fixed asset investment has been the biggest driver over the last 15 years. It's questionable as to whether that can continue to be the case. But ultimately, what you need to do is put more money in the pockets of households, boost investment sentiment amongst businesses. But we don't necessarily see that as being a priority. You rightly mentioned, overall, that Xi has been all about innovation, driving China to become a leader in certain growth investment areas globally in the economy, and technology being a key enabler for that. I think we're also likely to see out of the third plenum another initiative, which is to really shore up energy and food security. These are twin vulnerabilities for China, which have been the case for decades, and making sure that China has a policy in place in order to mitigate some of those vulnerabilities.
Mark, what's your preference, India versus China? How do you allocate between those two markets?
There's the short-term tactical, and then there's the structural longer term. I think short-term tactical, there is a case to be diversified across both of those markets. We mentioned earlier that India represents a long-term secular growth story. Valuations have rebounded significantly. China and Hong Kong equities obviously had a rally in April and early May, which dampened some of that valuation discount that it experienced at the start of the year. But it still remains at a significant discount, not just to India, but other regional equity markets as well. So with expectations a bit more measured in terms of what we could see from the third plenum or in terms of policy stimulus, there is the potential for a positive surprise there, either out of the plenum or out of the Politburo meeting in weeks to come. So Hong Kong, China, risk reward looks reasonable, but we like both markets from different time horizon perspectives.
Mark, you mentioned earlier 2 months is a long time, with September as the base case for the Fed rate cut. Do you see any Asia central banks moving ahead of the US central bank?
Short answer is unlikely. If you look at Indonesia as an example, it got itself into a very good position from a monetary policy perspective, real yields in excess of 3 percentage points. But its most recent move was a rate increase. And the reason for that was the dollar strengthening in the second quarter of this year led to some FX weakness on the Indonesia side, and they were worried about capital outflows. And so they raised rates in order to shore up FX volatility and capital flows. And so ultimately, the lesson from that is that even those Asian central banks that are in a strong position will wait and see what the Fed does, and will probably only act after they start cutting rates.
Mark, just quickly before we let you go, interested in your views on the Bloomberg question of the day today. Which of the so-called Trump trades make the most sense to you?
Yeah, it's a great question. We like the alignment of what his cyclical agenda would be with long-term secular trends. So one area that we think thematically has strong appeal is small cap industrials in the US. So the reason why the small cap element is interesting is because of that rotation towards cyclicals, a steepening of the yield curve. It plays into that as a factor, the small cap factor. And then industrials, because we do believe that Trump and JD Vance will espouse an agenda of reshoring of industrial activity, the creation of jobs, America first. And some of these smaller industrial companies in the US will benefit from supply chains being reshored back to the US, either in terms of being sub-suppliers into new production or service providers as well. So small cap industrials kind of ticks both boxes in terms of the secular trends and the cyclical policy agenda should Trump win.
All right, Mark Franklin of Manulife Investment Management, thanks very much for joining us today. And we have plenty more to come. This is Bloomberg. Welcome back. Equity trading standing out, topping expectations across the board in the latest US big bank earnings. Bank of America notching its best second quarter ever for stock trading. And we heard earlier from Bank of America CEO Brian Moynihan on how he plans to keep that momentum going.
We continue to invest along three dimensions. Technology, Jim DeMar and the team run it, and they've done a great job. And so 5-7 years ago, we made the decision to give them more capabilities. Technology, the balance sheet that they can use to help their customers achieve their goals, and talent. And so Jimmy across the board continues to increase. And so we feel good about it. He made $1.4 billion after tax this quarter, which is a very strong earnings quarter. But what's happening is you're seeing back-to-back $1 billion plus quarters. We're used to be $1 billion plus and drop to 500 when the market slowed down. You're seeing much more stability. The break-even point in the business is on a relative basis much lower. The best second quarter they've had since I think 2012 or something like that, which a lot of that was just when assets were marked up and came back through the system at profit. They've done a great job. And Tom Montag, 6-7 years ago, started this. Jimmy took it over, has done a spectacular job of implementing it, and we feel confident. We'll keep giving them more RWA, risk-weighted assets, balance sheet, capital, and investment in technology, because that's obviously very expensive business to run from a day-to-day basis.
Brian, I know you want to grow all the business of Bank of America, but do you have a strategy about the balance between what I would think of as a traditional bank lending, interest receipts, as opposed to the fee side, whether it's investment banking or asset management? Are you rebalancing the bank?
Well, this quarter happened to be half the earnings were from people, half the earnings for institutions. Out of the $25 billion of revenue, 14 was spread revenue, and 11 was, round numbers, was fee revenue. Because the market dictates a lot of the fee revenues, we could do it. But if you think about it from the businesses, in the consumer business, we made a decided decision to lower fee burdens on customers, and the trade-off for that was long-term customer favorability, running 88% across all the platform engagement places. The brand favorability in the 70%, up 20 points over the last 10 years. So we made a decision, lower the fee burden, but get it paid back in transactional accounts. Those are zero interest deposits. That's worked wonderfully. So we grow 1 million accounts a year. They start at $2,000 or $3,000. They mature to $7,000 to $10,000. It's all zero interest rate money. It's very strong. And that's, if it's a young kid, it's a customer of the future. And that's what we're doing. So that balance in fees there. In wealth management, it's all going to be about fee-driven. But the incremental growth, 7% increase in fees year over year, that's what we're driving there. Jimmy has a mix in the trading business, and then the commercial business is actually balanced. Investment banking fees, which everybody talks about, $1.6 billion, but the whole revenue in the business dominated by lending and deposits for corporate customers.
That is Bank of America CEO Brian Moynihan speaking there with Bloomberg's David Weston. Let's check in on a couple of China solar stocks that we're watching at the moment. We have seen some of these stocks performing pretty strongly after agreeing on a $3 billion deal for plants in Saudi Arabia. So we've got TCL Zhonghuan. This is the world's second largest maker of solar wafers. It's announced a partnership with the Saudi sovereign wealth fund PIF and Vision Industries on a $2.08 billion plant. Jinko Solar also making an agreement with PIF, joint venture there worth just shy of $1 billion. Got a couple of Chinese Saudi-focused ETFs doing pretty well also. Huatai Pinebridge's CSOP Saudi Arabia ETF, that gained as much as 9.5%, so it's taken the premium over the net asset value to about 15% over the past few days. China Southern Asset Management ETF, meanwhile, that's up, limit up, 10% for 2 days in a row now. So those ETFs performing pretty well in Hong Kong at the moment. All right, plenty more to come. This is Bloomberg. Have written that in already, so we're good to go. Cool. Welcome back. We've got markets in China just heading to the lunch break. It's a slightly soft session for the Shanghai Composite, off by about 1/3%. The CSI 300 are looking kind of flat. Meanwhile, I did mention those Chinese solar stocks that were performing well, but more broadly, the market kind of tepid today. And of course, we heard those remarks from former President Trump's interview with Bloomberg Business Week about the risk of more tariffs. The Shanghai Composite, I mentioned, off by 1/3%. The yen still looking pretty soft, 726.87. Sorry, that's the yuan, not the yen. All right, Avril is in Singapore, keeping an eye on some of the other market action. Avril, what are you watching?
Yeah, Paul, watching Japan as we are just about to come back from the lunch break. And today we've seen Japanese equities, particularly the cyclical stocks, doing well, extending gains. And this is fueled by those bets, optimism that we're seeing, not just Fed rate cuts, but also the optimism of a soft landing in the US after the bank earnings, as well as pretty solid retail sales numbers in the Japanese yen. We're still seeing it looking pretty cheap. And this is despite, we got the Bloomberg calculations, and that showed 2 rounds of intervention last week by Japanese authorities to kind of keep these speculators in check. We're going to see how it finishes the week, whether it's another close below 160 on dollar yen, a bit firmer on Japanese bonds. Let's flip the board and take a look at US Treasuries, because we saw a bit of a pickup on the longer end overnight and a flattening in the 2s and 10s. I think this is for the first time in 4 sessions. Certainly, if you look at how the steepener trade has been going, it looks a bit overbought, right? That buying on the short end and selling on the long end of things. Let's flip the board again. Something else that we wanted to highlight is also how those Fed rate cut bets are also fueling the smaller cap stocks overnight in the US. We saw the Russell 2000 outperforming the NASDAQ 100. This was for a 5th straight session. This streak is the longest we've seen since April 2020. And of course, this is a sector that is seen as benefiting from those rate cuts, because smaller companies are seen as more sensitive to higher borrowing costs given their debt load. So this is what we're seeing in the futures as well. A bit more pickup expected on the Russell 2000. Paul.
Well, more Wall Street economists are saying that the Fed is waiting too long to reverse course after raising rates to a 2-decade high. Tame inflation data, slowing growth, leading to calls for the central bank to begin easing at its policy meeting 2 weeks from now. So for more on this, let's bring in Bloomberg MLive Executive Editor Mark Cudmore. Mark, the consensus is growing around 1, possibly 2 rate cuts this year, but traders increasingly seeing July as a live option. And what are the risks in leaving rates live?
I think July is a live option, but only just about. In reality, I don't think that they will cut in July. And I actually think the more interesting trade for the second half of this year is that front-end yields probably have upside. It's not that we've got consensus between 1 and 2. We've actually got consensus at least 2 rate cuts coming before the end of the year. We're actually pricing in almost 3 rate cuts from the Fed by year end. And I think that's still a tough ask. You saw retail sales yesterday. It was very strong. We've seen earnings come out at the start of the season being strong. There's not yet a sign that the US economy is going off a cliff that would kind of warrant this sudden about face in monetary policy in the US. It's absolutely in play. There's very low certainty at the moment, which is why you can't have any strong conviction about a view. But I think that as we get close to 3 rate cuts being priced this year, I think there's actually a chance for yields to move higher from there, even though July is theoretically in play.
Well, some of those big tech names in terms of equities are looking pretty expensive. It's something we talk about quite a lot, but it appears there's a rotation now underway to small caps in the US. What are we seeing?
Yeah, look, I think we're seeing a broadening of the risk rally, and I think this is overall healthy for stocks globally, but a lot of people are going to suffer because obviously those mega cap tech names are where a lot of the exposures, they're a large part of the index. But I do think this rotation can continue. This idea that not just small caps can do well, but stocks around the rest of the world can also do well. There's a couple of components to this. I mean, it is with lower yields having been priced in to come in the US and the fact that growth continues to hold up, that is supportive for these small caps that have lagged for a long time, or these value stocks around the world. On the flip side, there is both the fact that Trump's VP pick of J.D. Vance has expressed an aggression against big tech in the past, and that's a bit of a worry there on that element. And we know that Trump has clashed with some of those big tech names as well. And at the same side, we are seeing, a little bit of worry that, is AI delivering the productivity gains yet? Have we priced in enough for the AI movement for now? This is not to doubt the overall long-term massive impact on humanity from AI. It's just saying maybe we've got a bit ahead of ourselves in the pricing. So I think that generally the rotation that we're seeing out of big cap tech into the broader stock market can continue, and not just the broader stock market, into stock markets around the world. I think emerging markets can benefit out of this, and I think overall it's a healthy dynamic.
We're still seeing a fairly soft yuan, Mark, and of course we're hearing more and more about what a Trump presidency would mean for China, particularly in terms of tariffs. What are we anticipating in terms of the yuan if we do see another term from President Trump in the White House?
Look, if Trump comes into power, first of all, I guess we don't have a complete certainty about what he'll impose, because many different things have been suggested. I think the highest conviction view is that tariffs will be imposed, and especially because he doesn't need the support of both parts of the House to impose some kind of tariffs. So that's where he has some more unilateral power. Tariffs would be very negative for the yuan. And that's why I'm actually quite surprised that, given the surge in the betting markets on the probability of Trump becoming president, that dollar yuan hasn't really gone anywhere this week. In fact, it's slightly lower than some of the highs of last week. And I think this is quite an interesting dynamic. I was expecting dollar yuan to trade a little bit higher. And that to me suggests that, in fact, if we do see a little bit of a fading of the so-called Trump trades, i.e., just a temporary, have we now traded the kind of recent days surge in polling? Maybe it'll come off a bit from here. Maybe dollar yuan actually has some downside potential in the short term.
All right, MLive strategist Mark Cudmore there. Well, Bloomberg has learned that the PBOC is starting a fresh round of checks on bond investments at lenders in at least 3 provinces. And this comes as the central bank prepares to cool a record-breaking rally in the nation's bond market. For more on those plans, our Asia FX and rates reporter Tanya Chan is with us. So, Tanya, what do we know about the PBOC's checks to cool this bond rally?
Hi there. Yeah, we know that they are obviously trying to take some unconventional measures, right, to cool this bond bubble that's been forming over the last 6 months. As you said, we have learned that the PBOC has been doing these checks with these regional lenders at least 3 provinces, looking to gauge how this bond operation may impact them, looking to see what some future steps could look like. And all of this kind of goes back to the fact that what is the PBOC trying to accomplish here? They're trying to prevent they're trying to help risk management at these smaller lenders. They want to prevent a Silicon Valley Bank-like crisis. They want to also try to keep this yield curve upward sloping. This protects bank profitability. In fact, today we were looking at the 7- and the 10-year bond yields. That curve has steepened quite a bit. So it seems like some people are actually taking into account what the PBOC is saying around the yield curve management.
Yeah, in terms of interpreting these moves, some of the PBOC's tactics are seen as hedge fund-like. Can you tell us more about that?
Yeah, I mean, we've spoken to a lot of economists whether or not central banks have ever previously done this, and by short selling essentially bonds to cool this rally. It's really been unprecedented. We've seen, the Bank of Japan, ECB, do versions of quantitative easing and tightening. And a lot of economists attribute to the fact that this is all due to monetary policy error, and the PBOC is not really different from that. In fact, if you look at the China's economy, I mean, it's in a deflationary environment. It should have been slashing interest rates right by now, but they've really withheld from cutting interest rates because they're really trying to prevent the currency from depreciating. And so if you look at kind of this bond rally over the last 6 months, it's really gained momentum because the market's been trying to shift its attitude towards what exactly the PBOC is trying to prioritize, and here it's the currency.
Yeah, so how likely is the PBOC to be successful when it comes to controlling this bond bubble?
That's a great question. At least for now, as I just said, it does seem like we are seeing some reversal in some of the moves. But long term, the PBOC may not win this war on yields, especially if you look at all the market forces that are taking place. Investors have nowhere to really park their money in good assets. Real estate's down, stock market's down. Even regulators are tightening the screws around, shadow banking. So right now, the investors onshore, offshore, are all really chasing the government bonds as a good way to park their money there.
So, Tanya, remind us how we got here and what are the driving forces that are challenging the PBOC at the moment?
Yeah, I mean, if you look at the economy right now, we kind of discussed how the currency depreciation pressures are really preventing the PBOC from taking further interest rate cuts. And so you're seeing the yield curve really flatten, especially on the ultra long 10 to 30, 50-year side. And as I just said, the investors, they're struggling to find ways to invest in China. For example, one of the usual kind of best assets that you would find in onshore would be these mortgage loans, but if you kind of take the returns on mortgage loans and CGBs right now, it's almost actually the same. So that 2% yield on government bonds is actually looking quite attractive to them.
All right, Bloomberg's Asia FX and rates reporter Tanya Chen there. Coming up, we discuss the biggest opportunities and challenges for India's wealth management industry. The CEO of ASK Private Wealth joins us next. This is Bloomberg.
India still has a very strong secular growth story, definitely refocuses the minds around the economic agenda, infrastructure build-up, but making sure that it enfranchises the rural masses as well as the urban populations. That's generally bullish for corporate earnings in the Indian equity market, but we do recognise that valuations have rebounded significantly since that initial pullback.
That is Manulife Investment Management Senior Portfolio Manager Mark Franklin speaking to us from a little bit earlier. All right, just want to get you across a Bloomberg scoop at the moment that's just hit the terminal. We've got the US warning allies of stricter trade rules in China and a potential extension of the chip crackdown. The Biden administration facing a pushback to its chip crackdown on China has told allies that it's considering using the most severe trade restrictions available if companies such as Tokyo Electron and ASML continue to give China access to advanced semiconductor technology. We're going to have more on that story in a moment after our next guest. But let's get a little bit more on India's outlook with Rajesh Saluja, CEO and MD of ASK Private Wealth, one of India's leading assets and wealth management firms, $10 billion in assets under management. Rajesh, thanks for joining us. We heard from one of our previous guests there, Mark Franklin, just a moment ago about how the investing landscape in India has changed, where he's putting money to work. I mean, you've been in business now about 18 years, I believe. How have you seen the wealth advisory and management business change in that time, and where are you seeing the opportunities now?
Good morning. Firstly, thank you for having me on the show. Indian wealth managers are very well placed to ride the economic growth that India is seeing, especially due to the financialization of savings, and that are also getting fueled into the capital markets. And some of the leading players are benefiting in a very large way due to the monetization deals and some of the operational efficiencies that are taking place in the Indian wealth management industry. You may be aware, but roughly about 1 to 1.2 trillion of financial assets are owned by India's HNI. And the Indian wealth managers especially have got close to 80% share in this segment as compared to some of the global players and banks. And we've seen that as a big trend play out over the last 5 to 7 years, largely due to the ability of the Indian firms to personalize solutions and customize to local needs very quickly in a nimble-footed way as compared to some of the larger players. India has a healthy savings rate of 30% of GDP and a savings pool of $800 billion. And investment in capital markets has also gone up from 2% in FY16 to now close to 7%, of household savings getting into a capital markets. Even the number of ultra HNIs, which are roughly 13,000 odd, this number has been growing by 12 to 13% every year. So between HNI and ultra HNI segment, we are seeing a fairly secular growth, and that's really opening up a huge potential for all the Indian wealth management players, including us.
Yes, so we are seeing a narrative of growing wealth, a growing middle class, more wealthy people in India as well. So how do you expect you're going to be increasing your assets over the next few years? And are you going to be hiring more relationship managers?
Yes, given, we are seeing also a large number of HNIs coming in from tier 2 and tier 3 cities, which was not there earlier. So I think one of the strategies is to expand our distribution footprint from 15 to 25 cities. Also, we are looking at a global footprint because a lot of non-resident Indians are very keen to invest back in India. So we've taken licenses in Dubai, Singapore, and soon in London. So we are adding relationship managers, really increasing from a number of 70 to 200, literally in about 18 months. So very aggressive expansion to cater to some of the requirements that have come about for all the reasons I mentioned. Monetization, people moving away from traditional hard assets into financial assets, and also a lot of product innovation that is taking place, aided by the regulator and some of the new Indian wealth management firms that are providing many unique investment ideas as compared to traditional vanilla products to the HNI and ultra HNI segment.
Have you tapped into Gift City when you're looking to introduce products for your wealthy clients?
Of course, it's a key part of the strategy, both for clients who are looking to invest outside India and diversify. And we've seen that trend over the last 7 to 8 years, along with all the non-resident Indians and foreign nationals, including institutions that want to tap into India. Gift City is a very good alternative. So we have taken an office there, taken a license, and also launching a couple of investment funds through that, through Gift City.
How are you reaching some of your clients that are in India's smaller towns? And do you find that perhaps their needs are different in the ways from some of your clients in the bigger cities?
Yes, I think the exposure to financial assets is still limited, although we are seeing this trend not only in tier 2, but even in tier 1 cities, where the next gen who have studied abroad have come back, and they are more keen to look at financial portfolio and financial investments rather than traditional investments into real estate. So that's a big driver. Having said that, in tier 2 and tier 3 cities, since their exposure is recent and their experience is limited, they tend to be more conservative in the way they look at investments.
Rajesh, before we let you go, one of the themes we're talking about at the moment is the possibility or the probability of a second Trump presidency, what that means for potentially a stronger US dollar, a weakening emerging market currencies. How are you factoring this into your investment advice?
There will always be some geopolitical challenges from time to time, whether it is, US or China. The way we look at advising clients is more from a longer term perspective. One, of course, expectation is that post-elections or closer to elections, or maybe by the end of this year or early next year, there would be rate cuts. So we are aligning fixed income portfolios, keeping in mind an expected rate cut. But from a longer term standpoint, I think this decade is probably going to be a golden one for India. We are one of the fastest growing economies. Even the central bank has predicted close to 7.5% GDP growth. And all the other factors that I mentioned, government capex, private capex picking up in lots of segments. This is making India look at a very, very attractive sort of scenario for the next 5 to 10 years. So we are keeping clients focused on the long term. Geopolitical challenges or newly elected presidents or changes in government could have shorter term impacts. But from a long term perspective, we are very, very bullish in India.
All right, Rajesh Saluja of ASK Private Wealth, thank you so much for joining us today. Now let's get back to that breaking news from a moment ago. Take a look at shares of chip equipment makers in Japan, slipping a little following that Bloomberg scoop we mentioned. We are told that the Biden administration is weighing even tougher rules for overseas firms seen as enabling China's semiconductor industry. Tech reporter Annabelle Drewlers joins us now with the details. Bell, exports have already been restricted, so what's the focus now?
Well, the focus could end up being on any and all equipment from major chip making or chip equipment providers. As you say, yes, those restrictions, they're already in place. So at the end of last year, for instance, we saw major players like Tokyo Electron, you can see that big slump there, ASML in the Netherlands as well, essentially restricted from selling some of the most advanced technology to China. What hasn't happened, though, is the servicing or the maintenance, because the likes of Tokyo Electron, ASML, they've continued to maintain the equipment that Chinese companies already own. And the importance of that really just can't be understated, because if you don't service chip equipment, then it can actually stop working within a few months, definitely within a year. And so that's an issue for the US, because if you've got those companies like Tokyo Electron, like ASML, that keep maintaining their machines, then essentially you're continuing to enable China with its chip-making ambitions.
All right, so with that in mind, how could the US go about doing this?
What they could impose is a measure called the Foreign Direct Product Rule, or FDPR. It's essentially a rule that puts in place restrictions or controls on foreign-made products that use even just the tiniest amount of American technology, which is why I said basically any and all of equipment could be targeted by the FDPR. What sources are telling us is that this sort of idea or plan is being touted or discussed with officials in Tokyo, The Hague, if Japan and the Netherlands don't tighten their own measures on China. The US, of course, in a very tricky position, though, because there's also that question of how much are allies going to be listening here when you've got the US presidential election just a few months away.
All right, well, we've got the shares in Tokyo Electron. They're getting hit pretty hard at the moment, off 6.25%. But have we heard from the tech companies yet? What are they saying?
So Tokyo Electron didn't give any commentary for this article, neither did ASML. But what we're hearing behind the scenes, in Japan at least, is that the government isn't going to be enforcing any such efforts. There's also been the reaction that's come through, or what we've heard from sources from the US equipment makers, the likes of Applied Materials, Lam Research, KLA, and we hear that they're also actually voicing opposition to it. Their concern is that if you invoke FDPR, then essentially you could be in a position where it backfires, because the Netherlands and Japan, they could end up being so defiant that they end up stopping cooperating with the restrictions that are already in place. And so the prospect, certainly, of this just tells you at a bigger picture level that the attempt to form a unified approach against or front against China's chip-making ambitions is falling short, Paul.
All right, Annabelle Drewlers there. Plenty more to come. This is Bloomberg. All right, so let's check in on how markets are faring at the moment. In particular, chip stocks, Asian chip stocks as well. We did hear a moment ago about this Bloomberg scoop that the Biden administration weighing even tougher trade rules in a chip crackdown on China. A number of stocks are suffering as a result of this. We showed you Tokyo Electron a little bit earlier. Well, there it is now, off by about a little bit more than 6% now. SK Hynix off by 5.3%. We've also got some earnings coming out as well today from ASML. This is the company that supplies lithography machines. Net sales expected to be 6 billion euros, but those earnings are going to take on a keener focus on the back of this news. We've also got a central bank decision coming up today. We're going to be watching for the latest decision from the Bank of Indonesia. That comes out just after our show. Economists widely expect the central bank to stay on hold for a third straight month. We have seen the rupiah weakening along with other Asian EMFX, incidentally, but the Bank of Indonesia on hold might help support the currency. That is it from Bloomberg Markets Asia.